In January 2019, one company was worth $47 billion. More than Ford. More than FedEx. Its founder? Called a visionary. Investors were throwing billions at him. Just 10 months later, that same company was worth $10 billion. 4 years after that? Bankrupt. $19 billion in debt. This isn't a story about a bad business idea. It's a story about how belief can be manufactured. And what happens when reality finally shows up.
This is WeWork. And before you think, oh, another office company that couldn't survive COVID, that's only half the story. The real collapse started before the pandemic. It was caused by the company's own founder. And it reveals one of the biggest lessons in business. Growth funded by other people's money is not the same as a working business model. It starts in 2010. Adam Neumann and Miguel McKelvey opened the first WeWork location in SoHo, New York. The pitch is simple. Take long-term commercial leases, renovate them into flexible co-working spaces, and rent out desks short-term at a markup. By 2014, they raised $355 million. Valuation jumps to $5 billion. Then, in 2016, everything changes. Neumann meets Masayoshi Son, CEO of SoftBank, known for making massive, high-risk bets. That meeting leads to SoftBank committing $3.1 billion in funding. This is the turning point. Son reportedly told Neumann WeWork wasn't being aggressive enough, that the company should be, quote, 10 times crazier. From here, WeWork stops acting like a real estate company. It starts acting like a tech startup, opening locations before demand was even proven, all funded by SoftBank's cash. By January 2019, the valuation peaks. $47 billion. The most valuable startup in America. Here's what almost nobody outside the company knew. WeWork was losing enormous amounts of money. In 2018 alone, it lost $1.9 billion on $1.8 billion in revenue. That means for every $1 it made, it spent almost $2. Nobody noticed because it was private. Private companies don't have to show you their books. That changed in August 2019 when WeWork filed for its IPO and had to release its real financials for the first time. This one document destroyed the company. Investors saw the real numbers, and they discovered something else, too. Adam Neumann had trademarked the word "we" and sold it back to his own company for $5.9 million. He leased buildings he personally owned to WeWork. And he structured his shares to give himself 20 votes per share, meaning he controlled the company even with a minority stake. Within weeks, Wall Street's excitement turned into panic. The IPO was pulled. By September 2019, Neumann was forced to resign. The valuation collapsed. $47 billion down to $10 billion in a matter of weeks. He walked away with a reported $1.7 billion exit package, while 2,400 employees lost their jobs. SoftBank steps in, saves the company from immediate collapse, effectively bailing out its own bad bet. But the damage is done. WeWork is now a wounded company. Broken brand. Billions in long-term lease obligations for buildings nobody wants anymore. Then COVID hits. Overnight, the entire premise of co-working, putting strangers close together in a shared office, becomes a liability instead of a feature. Occupancy craters. In October 2021, WeWork finally goes public, not through the failed 2019 IPO, but through a SPAC merger. It debuts at $9 billion, a fraction of its 2019 peak. But by then, it's already too late. The company is locked into thousands of expensive leases signed during its growth at all costs era, while actual demand for office space keeps shrinking. November 6th, 2023. WeWork files for Chapter 11 bankruptcy. Its stock falls to 84 cents a share, giving the once $47 billion company a valuation of just $44 million. SoftBank alone loses more than $14 billion. Here's why this story matters, beyond the drama. WeWork didn't fail because co-working spaces are a bad idea. Flexible office space is a real, ongoing need. WeWork failed because of 3 specific mistakes. Mistakes that apply to any business. 1. It confused funding with validation. Every time SoftBank wrote another check, it felt like proof the model worked. It wasn't proof. It was just cash covering up losses. 2. It scaled faster than it could operate. WeWork signed leases in cities before proving demand existed there. Growth became the goal, not profitability. 3. Governance failures removed all checks. Neumann's supervoting shares meant nobody, not the board, not investors, could challenge his decisions, even when those decisions were clearly reckless. The lesson, for any investor or founder watching this, growth financed by debt or investor cash is fragile. Growth financed by actual profit is durable. WeWork looked unstoppable right up until the moment its real numbers became public. And then it collapsed in months. WeWork isn't a one-off story. It's a pattern that repeats across industries. If you want to see this exact same trap play out in a completely different sector, check the next video. We break down a company that made the identical mistake, just with real estate instead of desks. Drop a comment. What other company do you think fits this pattern? I'm reading all of them.